Let's take a simple idea. I invested 100 euros a month for 40 years straight with an average 10% return, and I managed to get 555,000 euros. Guess how much of that is actually my money? 48,000. What do I mean by that? I actually put only 48,000 in, and I got 555,000 back. How does that work? Well, that's the compound interest. I mean, it's quite simple when you understand it, and it's super horrible when you don't understand it. Einstein once said that it's the eighth wonder of the world, and the ones who actually understand it earn from that. The ones who don't understand it actually pay that. Compound interest overall works great when you invest in stuff. So it does help if you're an investor, and it doesn't help if you're not an investor. Now let's jump into a bit of a calculation and show you where the compound interest effect comes from and how you can actually use it for yourself, and what happens if you invest 100 euros, 200 euros, or even 300 euros or more over a longer period of time. So our simplest situation is 0 initial investment, 10% annual average, which is S&P 500 last century average, and we take a significant amount of years. Now 100 euros each month, we press calculate and you end up with 555,000, even though you invested only 48,000. If you look at the graph, the orange part is the compound interest. Compound effect is rapidly increasing because the blue line is the amount of money you actually put in. Now, some of you might think 555,000 is not that much. Well, let's not forget that quite a few of you actually earn significantly more money and can invest a lot more than 100 euros. Let's take an example with 1,000 euros a month, and we have 5.5 million. Now, some of you think, oh, now we're talking. So, idea is quite simple. If you do have small sums, now you have to go for a long period of time. If you have short period of time, you have to go for significantly higher sums. And some of you are in a position where you don't necessarily have a lot of time, but you do have a quite massive initial investment. Let's take, I don't know, 500,000 as an example, and let's say we invest 200 euros a month, but we only have 15 years. Now, you can see that it's quite a significant jump straight away, and from that point, you can start taking a certain amount of money out of your portfolio without ever risking to run out of money. What do I mean by that? Let's take a simple example, 2168373. Let's assume we average 7% return, and we have another 20 years, and now we only withdraw money, and let's say we withdraw, I don't know, 1,500 euros a month. Calculate. You can see that you end up with too much money. So you initially could increase it to, for example, 2,000 a month, 5,000 a month. Now, in this instance, you're still making too much money, and you could take that 5,000 euros each month and continue doing it for forever. You could be a vampire and live 10,000 years, as long as that amount of money is enough, and as long as you make that 7% return, you're fine. Now, we did jump to quite a few assumptions. So let's say you're a beginner investor. You don't know what investing really is. You just know that it's making money from all sorts of stocks, ETFs, bonds, and something like that. In this instance, let's take a very simple approach. Let's assume you have a significant time horizon, which is 40 years. Now, let's say you don't have any initial investment. You have those 40 years, and you want to put 100 euros each month into that account. Let's make deposits. 100, calculate. We already calculated that, 555,000. Now what happens if I put 200? We get over 1 million. No surprise there. 300, 1.6 something million. The idea here is if you put more money, you can potentially reduce the time. So for example, if I invest 300 euros a month, I managed to reach bigger goal within 30 years than the person who puts 100 euros for 40 years. So that's where the balance comes from. You either have to choose a longer time horizon, or you have to choose a higher sum to invest in. Now, some of you might say, wait a second, okay, I get the idea of investing that 100, 200, 300 euros a month, But where? The simple idea is index funds and passive index funds. To understand what index funds are, I have a screen which is S&P 500. Initially, it's one-day example. It's a map of companies which is tracked by S&P 500 index, which is top 500 companies from USA. Now, historic average from S&P 500 is around 10%. If I go into more details explaining what S&P 500 is, it's top 500 companies from America now, tomorrow, in 10 years, in 50 years, and so on and so on and so on. So if you believe that the businesses in America will do well in the future, I think that's the idea where you can invest. If you're a little bit more cautious, I would suggest to go with the whole developed world. Now that simply looks by searching for ETFs. We can either pick SPYL, which is S&P 500, cheapest European ETF ever, and just don't forget this SPYL, or we can go into the developed world, which is iShares Core MSCI World. We can either pick EUNL or IWDA. Now the Just ETF website just gives us a bit more information of where are we investing. Now we can open the fact sheets, kids, and so on, and read about which index, which countries, and so on. Look at historical returns, look at sort of 1 year, 3 year, 5 year, so on, examples, as well as the top companies, top sectors, and geographic breakdown. If you do decide to invest either in MSCI World, which is developed countries, 23 developed countries altogether, or S&P 500, you're still gonna need a brokerage. Usually to open a brokerage account, it's completely for free. I'm using Freedom24 just as an example. If you do want to check out these portfolios, you have an ability to track my portfolios and see where I'm trading and what I'm doing. The idea here is to convince more people to see how you can do it yourself. If you do have a brokerage report, you do have some sort of search window. I would just simply suggest to SPYL, one of sort of easy solution here. Now, because it's accumulating ETF, it doesn't have any dividends, but you can invest in euros and it only costs 12-13 euros per unit. Now, the second one is EUNL, and let me check this just for a second. This is euro version as well. Now, idea is that these two should be enough to cover you for majority of the strategies as a core position where you invest majority of your money. Don't forget, this is not advice. The disclaimer is quite simple. Have a look what I'm doing. Have a look what investments could bring you in return of a little bit of time and a little bit of money on the side. At the same time, if you do decide to follow my journey along, this could easily become one of those trips where you're gonna think, why I haven't started it earlier. One of the examples, like I've started 2.5 years ago, my practical experiment with S&P 500, where I invest in VUAA. I don't do anything else. I just simply buy 1 unit of S&P 500, which is VUAA in dollars. And this is the result from me spending 1 minute a month in investing in this fund again and again and again. So just buying more units again and again. Now, I know that this video is a little bit loose. I wanted to just share a bit of a compound interest effect and a bit of an idea of how I would go along with just building the initial portfolio. But to summarize it well, I would go with either a developed markets or just America on its own. And I would go on a long-term basis. So I would look to invest for at least 10, 15, maybe even 20 years with a periodical sum which continuously increases following the inflation. When you see that your money can work for you without you working there, it changes the mindset. Don't forget, the goal of this channel is to show a lot more people that investing is not as hard as they potentially thought at the beginning, and to show them that the beginner steps are usually very user-friendly these days. So the main question remains if you actually going to do something with that information or just look from sort of aside and think, that's possible, but that's not for me. So my goal here is just to convince you, to show you that investing world should be open for everyone who manages their finances. And if you don't yet manage your finances, don't forget that this channel is super user-friendly for any beginner investors. If you do have questions, feel free to leave them in the comments. I do respond to all of them, and I'll see you next week.